What if the only thing separating you from a millionaire isn't the money you start with, but the way you behave on the worst day the market has ever seen? Be honest with yourself. When the news is shouting disaster, would you sell because everyone else is scared, or would you sit still because your plan is stronger than the panic? I want to take you on a short time travel experiment, because inside that story is the entire secret to building wealth from almost nothing. Picture it. You start investing in 1985. You don't know yet that history is about to test you, repeatedly. At first, it's easy to feel clever. Your balance goes up, your confidence rises, your friends start asking for tips. Then a single Monday knocks the wind out of Wall Street. Screens turn red. Anchors say the words, "record collapse." You feel your stomach drop. Your friends tell you to get out while you still can. But you hold your nerve. Days pass, weeks pass. The world keeps turning. Prices stabilize. Quietly, painfully, slowly at first, the market recovers. You start to believe again. Then another monster arrives. This time it has a catchy name and a new technology behind it. Euphoria builds. Then the air rushes out and everything falls together. More whispers. More advice from people who don't have a plan. You stay invested. You keep adding small amounts. You learn to breathe through the drama. You think you've seen it all, but you haven't. A once-in-a-generation financial crisis slams the brakes on everything. You watch respected names disappear. You ask yourself, if this time is different, you keep buying your modest monthly amount anyway. It feels almost foolish to be so calm when everyone else is loud. Then a sudden global shutdown freezes life itself. Headlines compare it to the Great Depression. The market plunges, then in a move that makes no emotional sense and perfect mathematical sense, it rockets higher and sets new records. That entire roller coaster, with all its panic and pain, was your education in compounding. And if you had invested something as small as $250 a month since that first step in 1985, through booms and busts, through fear and boredom, you would have turned tiny contributions into roughly 1,141,521. They'd at an average annual return of around 11. 23 across that span. That's a gain north of 6,000, before even considering that many people contribute more as their income grows. Let's be clear, I'm not promising a number, I'm showing a truth. Time in the market plus a consistent process beats timing the market plus brave guesses. The path is not smooth. The news will tempt you to interrupt compounding. But if you can learn to keep calm and keep going, your results will look less like a straight line and more like a staircase, flat stretches, scary drops, and then sudden leaps that only reward the people who are still standing on the staircase. Now, let's translate that story into actions you can take from your phone today, even if you're a complete beginner. Before any investing, take care of your foundation. Build an emergency fund of 3 to 5 months of living expenses in a simple savings account. That cushion keeps you from yanking investments at the worst possible moment. Once your safety net exists, you're ready to build your plan. I'm not your financial advisor, and this isn't personal advice, but I will give you a simple, repeatable system that has worked for millions of people across decades, and you can tailor it to your country, your income, and your nerves. The first step is to open the right type of account. Different countries give different tax advantages to long-term investors. In the UK, many investors use a stocks shares ISA, which allows investments to grow and be withdrawn tax-free within annual allowances. In the United States, many beginners start with Roth IRAs for long-term tax-advantaged growth or with taxable brokerage accounts if they need flexible access. In Canada, the TFSA offers powerful tax-free growth and withdrawals within contribution room. In other places, there are equivalents. The names matter less than the principle. Choose an account that legally minimizes taxes on your long-term gains. That one decision, done once, can add more to your future than most stock-picking tips you'll ever hear. Opening the account is straightforward now. You download a reputable broker or investing app, complete identity verification, and you're in. Pick a platform known for low fees, clear interfaces, and solid security. Use a strong password stored in a password manager. Turn on two-factor authentication. These small steps matter. Wealth isn't just earned, it's protected. Next, fund the account. Start with whatever amount doesn't scare you. $10, $50, $400. It's not the first deposit that changes your life. It's the system you build around it. Your goal is to automate a small, regular contribution, so your plan runs even when you're busy or bored. Weekly is better than monthly for building the habit quickly. If you're paid every 2 weeks, set the transfer the day after payday. Paying your future self first is not a slogan. It's a lever. What should you buy? If you're a beginner, your default should be simple. Own a wide slice of the market at low cost and let the market's engines, the profits of thousands of companies, work on your behalf. That's what a broad index fund does. Think of it like a constantly updated playlist of the economy's biggest and most relevant businesses. When a company thrives, it takes a bigger share of the playlist. When one fades, it slides down and can be replaced. You don't have to keep track of who's hot this week. The index does that for you. With one purchase, you own tiny pieces of hundreds of companies. If one stumbles, the rest keep marching. You are no longer trying to be a genius. You are trying to be consistent. Here's how you make that consistency effortless. Turn on automatic recurring purchases of your chosen index fund. If your app offers a recurring buy, set a small daily or weekly amount. 5 units of your local currency a day is roughly the price of a coffee. It won't feel like much. That's precisely why it works. You're sneaking wealth creation into your life by making it smaller than your excuses. Reinvest dividends automatically so that every payout buys you a few more shares. Over time, those shares buy more dividends, which buy more shares. That's compounding in practice. It never looks dramatic in the first year. It often looks astonishing in the 20th. You might be thinking, this is too boring. Where's the excitement? Where's the stock that triples overnight? Let's talk about individual stocks in a way that respects both your curiosity and your future. Picking single companies can be educational and rewarding. It can also be punishing and distracting. The right way to learn is to treat stock picking as your lab, not your core plan. Keep your experiments small and your process simple. Build a checklist that you must complete before you buy anything. Do you understand in one sentence how this company makes money? Are revenues and profits growing steadily, not just in a single year? Is the company generating free cash flow? Is debt reasonable relative to earnings? Are there clear competitive advantages? What could break this story? If your answers are vague, you're not ready to own it with real money. Spend time reading the company's income statement, balance sheet, and cash flow statement. Most apps link them directly now. Learn who leads the business and how they allocate capital. Then, if you still believe, buy a small amount and commit to holding through noise for 2 to 5 years while you monitor the business, not the stock price. When you place an order, you'll see terms like market order and limit order. A market order says, buy at whatever the current price is. It fills fast, and for most beginners, it's fine for liquid, large stocks. A limit order says, buy only if the price drops to this level. It gives you control, but it might not fill. You don't need to master every order type. Start simple. Don't trade because of boredom. Don't chase because of a headline. The compounding machine hates drama. Now, let's talk about an underrated feature offered by many modern apps. Building a small basket or pie that you fund automatically. This is helpful if you want to split your contributions between a broad index and one or two other holdings without thinking about it each time. For example, you might allocate 80 to a broad market index, 10 to a global ex-home index for international exposure, and 10 to a dividend-focused fund if you like some income. Or you could add a tiny slice of a real estate investment trust for rental-style income without owning property directly. The key is to keep it simple enough that you can explain it to a friend in 1 minute. If you can't explain it, you won't stick to it. Speaking of real estate investment trusts, they deserve a moment. A REIT bundles many properties, offices, apartments, warehouses, data centers, healthcare facilities, collects rent, and pays out most of its profit to shareholders as dividends, often because the law requires high distribution. That's why our REITs can provide a steady stream of income. You can buy a diversified REIT fund from your phone. You don't deal with tenants. You don't fix leaky roofs. You still participate in real estate-driven cash flows. They are not risk-free interest rates. Vacancies and economic slowdowns matter. But as a small part of a diversified plan, they can be a useful complement to your index. Gold is another tool you'll hear about. It doesn't produce anything. It doesn't send you a check. It just sits there. And yet, during inflation, currency wobble, or crises, it has often held purchasing power surprisingly well. If you want that ballast in your mix, you can buy a gold fund instead of storing coins at home. Keep the allocation modest. Remember its job. Stabilize, not sprint. And yes, crypto exists. Bitcoin and Ethereum are the two names you'll hear most often because they've endured the longest and built the widest networks. They are volatile. They can soar and crash in ways that feel unreal until you've seen them twice. If you choose to own some, understand custody and security before you buy. Know the difference between an exchange account you log into and a wallet where you control the keys. Never share recovery phrases. Never stake or lend coins you can't afford to lose. Treat crypto like a venture bet, a small slice you can ignore for years. For most beginners, it should never be the core of your plan. At this point, you might wonder, is this actually worth it if I only have small amounts to invest? Watch what a tiny daily habit can become. There's a reason I love recurring buys set around the price of a coffee. One investor I know ran an experiment, a small automatic contribution to a broad index fund every day for 3 months, then 6 months, then a year. He didn't try to pick peaks or bottoms. He simply honored the schedule. The balance didn't explode overnight. It compounded. Watching that steady green number grow became a quiet daily reward. In a world designed to steal your focus, building one habit that quietly funds your future is the most rebellious thing you can do. Let's also address a question that keeps people frozen. What if the market crashes right after I start? It might. That's not a bug. That's a feature. If you're setting up recurring purchases, a drop simply means you buy more shares with the same dollars. That is dollar-cost averaging. You will never catch the exact bottom. You will also never pay the exact top for every share when you spread out your buys. Over decades, this simple discipline turns volatility into a tailwind. The real risk isn't buying before a drop. It's delaying for years and missing the compounding that only happens while your money is actually invested. The difference between starting at 25 and starting at 35 is not 10 years. It's millions of future dollars if you plan to stay invested for a lifetime. The graph of money if I started now versus money if I waited a decade looks like a jaw opening. Don't stand in the way of that jaw closing on your future. Now, a few practical scripts you can borrow to make this real tonight. When you open your investing app for the first time, say to yourself, I'm not here to be entertained. I'm here to set up a machine. When you choose your index fund, say, I will own the market and let winners rise inside it for me. When you set your recurring buy, say, This small amount happens whether I feel like it or not. When the market dips and your screen turns red, say, has my time horizon changed? No. Has my plan changed? No. Has my need for this money today changed? No. Then I don't change either. When you feel the itch to speculate with too big a bet, say, experiments are small by definition. My core plan pays future 'em. Your words guide your actions. Your actions build your identity. Your identity keeps you consistent when motivation fades. Let's walk through a clean sequence for beginners who want a step-by-step on a phone without the fluff. You download a reputable investing app. You verify your identity by submitting your details. You choose the account type with the best long-term tax treatment available to you. You connect a bank or card to deposit funds. You move a small starter amount. You search for a broad, low-fee index fund that tracks a large, diversified market. You enable dividend reinvestment if the platform offers accumulation share classes or automatic reinvestment. You create a recurring purchase daily, weekly, or monthly. You pick an amount small enough that you won't cancel when life gets noisy. You write down in your own words why you chose this plan. I will buy the market consistently for decades so I can own a share of human progress. Save that sentence in your notes. You've just built a plan most people never build. From there, you can layer in a small REIT position for income, a tiny gold slice for ballast, or a small individual stock position for your learning lab, only if you've done the work to understand it. Remember, the value projection charts many apps show when you set up automatic investing? They're not promises, they're compasses. They use historical average returns to illustrate what could happen if you contribute for 30 or 40 years. For instance, contributing the equivalent of $250 a month for 31 years could show a 7-figure outcome in those projections. Stretch to 40 years, and the curve bends even higher. The message is not, you will be a millionaire. The message is, small, consistent inputs over long periods can create results your present self can't emotionally grasp. The projections are there to open your imagination and keep you consistent, not to guarantee a number. Let's also demystify the two main analysis styles you'll hear when people talk about stocks. Technical analysis looks at price charts and patterns. It asks, what do these movements tell me about probabilities? It can help short-term traders, but requires a temperament and a time commitment that most beginners don't actually enjoy. Fundamental analysis looks at the business itself. It asks, how does this company make money? And can it make more over time? That's where you study revenue, margins, cash flows, debts, leadership, and competitive modes. If you're going to own individual companies, be a student of fundamentals. But never feel pressured to become a stock picker. The market doesn't pay extra for difficulty. It pays for discipline. You may also see social features in modern apps lists of popular stocks, top holdings, or pies others have built. Browsing those can be educational. Copying them blindly is not a plan. Remember the darts we threw in our time travel story? Randomness can look smart in bull markets and cruel in bear markets. You want a process that survives both. Now let's speak to the fear that keeps the smartest people poor. The fear of looking foolish. You might feel embarrassed starting with tiny amounts. You might feel late. You might feel like you should understand everything before you begin. Here is your permission to start messy. You can increase your contributions later. You can refine your mix later. You can read more later. But you cannot reclaim the months you spend waiting to be perfect. The market rewards the person who shows up early and stays, not the person who reads 1,000 threads and never places the first order. If you want a 14-day starter program to lock this in, do this. Day 1, open your account. Day 2, fund it with a tiny amount. Day 3, set up a recurring contribution as small as it needs to be to feel automatic. Day 4, buy your first fractional slice of a broad market fund. Day 5, turn on dividend reinvestment or choose the accumulation version. Day 6, write your one-sentence plan and save it. Day 7, turn on two-factor authentication and store recovery codes safely. Day 8, read a short article about REITs and decide whether to add a tiny position. Day 9, clean your phone of 3 distracting apps and replace that habit with a 2-minute portfolio check and a 5-minute read about investing fundamentals. Day 10, audit your subscriptions and cancel one. Increase your recurring contribution by that amount. Day 11, learn the difference between market and limit orders by placing a tiny limit order on a company you understand. Day 12, do nothing, practice patience. Day 13, review your plan and remind yourself what you will never do. Never invest with borrowed rent money. Never stop contributions entirely unless your income stops. Never chase a tip you don't understand. Day 14, take a walk and say out loud, I am someone who invests automatically and calmly for decades. That identity is worth more than any tip you'll hear this year. A word about taxes, because keeping what you earn is as important as earning it. If your country offers tax-advantaged accounts, use them as the home for your long-term holdings. Contribution limits and rules change, so check the current numbers rather than relying on something you heard last year. Understand when contributions are taxed and when withdrawals are taxed. Some accounts give you flexibility to withdraw without penalties. Others reward you for leaving the money for retirement. Match the account to the job. If a tax wrapper lets you reinvest dividends and gains without a bill each year, that removal of drag is a compounding multiplier you don't feel month to month, but you'll see in the final balance. Let's return to the story we began with, because stories plant ideas deeper than bullet points. The person who started in 1985 and lived through crash after crash didn't win because they were the best stock picker on earth. They won because they refused to interrupt compounding. They systematized contributions. They used the right account types. They ignored the loudest days. They let boring habits outperform exciting hunches. Your life won't look exactly like that timeline, but I can promise you this. There will be another worst day ever. There will be several. You can decide today how you will behave on those days. Write it down. On the worst day, I will keep buying my small amount. I will not sell my core holdings. I will go outside. I will message a friend. We prepared for this. Then I will do nothing. That decision, made once, protects you for decades. One more mental model to keep you steady. Think of your plan as a factory. Your income delivers raw materials. Your automatic transfers move raw materials from the loading dock to the assembly line. Your chosen funds are the machines on the floor. Your security settings are the locks on the doors. Your behavior is the electricity. People outside will argue about which machine is shinier this month. Meanwhile, your factory produces every week, every month, quietly. If a machine breaks, you replace it. If a new, more efficient machine appears and proves itself, you consider it. But you never shut down the power, because there's a storm outside. Let's end where we began, with a question. When the world shouts, "Sell," who do you want to be? The person who mistakes noise for news and surrenders a decade of compounding in a single emotional afternoon? Or the person who looks at a plan written on paper, remembers why they built it, and does nothing, because doing nothing is the work? Millionaires are not better than you. They are often just earlier than you, calmer than you, and more consistent than you. That is a gap you can close with a few decisions you make today. Take 60 seconds right now. Open the app you'll use. Begin the identity process if you haven't. Move a tiny amount. Set one recurring buy, even if it's the smallest amount allowed. Write a single sentence in your notes. I invest a little automatically for a long time. That's it. You've taken the most important step. In a few years, Someone will ask how you knew when to start. Smile and tell them the truth. You didn't know. You just refused to wait. You chose a system over a story. You chose calm over chaos. You chose to be the person who keeps compounding when the world forgets how.